Private equity firms have poured billions of dollars into car washes, and that's exactly why this 6% cap rate on a Rapid Express car wash in San Antonio, Texas caught my attention. Because when most investors hear the words car wash, they still picture a sleepy mom and pop business run by local owners hoping enough cars show up on a Saturday morning to make payroll. But that's not what this industry looks like anymore. Over the last decade, the car wash business has quietly transformed into one of the most aggressively pursued sectors in commercial real estate. Private equity firms, institutional investors, and large operators have spent years consolidating the industry, acquiring locations, building regional platforms, and creating reoccurring monthly membership programs that generate predictable revenue streams. In many ways, some of today's largest car wash operators have more in common with Netflix than they do with the traditional car wash most people grew up with. And that's exactly why I think many investors are looking at this deal the wrong way. At first glance, this appears to be a fairly straightforward triple net investment. A 20-year absolute triple net lease, a 6% cap rate, annual rent increases, a relatively new building, a Texas location. On the surface, it checks many of the boxes passive income investors are searching for. But I don't think investors are really buying a car wash here. I think they're buying a private equity-backed subscription business wrapped inside real estate investment. And the question I kept coming back to while reviewing this offering memorandum is whether the 6% cap rate properly compensates investors for the risks that come with that business model. Because when recurring revenue businesses are growing rapidly, investors often become willing to accept lower returns in exchange for perceived stability and future growth. Sometimes that's justified, sometimes it isn't. And that's where this opportunity gets interesting. Welcome back to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer, commercial real estate broker, business broker, and the agent who goes beyond the glossy brochure to help investors understand what they're actually buying. Because when I evaluate an investment opportunity, I'm not just looking at the lease and the location, I'm evaluating the business behind the real estate. Because if the business weakens, the real estate eventually becomes vulnerable in ways most investors never anticipated. Now, let's dive into it. The property we're looking at today is a Rapid Express car wash located in San Antonio, Texas. The property is being offered at just under $5 million with a 6% cap rate and a brand new 20-year sale leaseback structure. The lease is absolute triple net, which means the tenant is responsible for taxes, insurance, maintenance, roof, structure, and virtually every property level expense. From a landlord's perspective, this is about as passive as commercial real estate gets. The lease also includes annual rent increases throughout the base term and option periods. That's important because many older triple net leases provide little or no rent growth. Inflation has reminded investors that a dollar today is not worth the same as a dollar 10 years from now. Having contractual rent growth helps protect purchasing power over time. My overall impression of the lease structure is positive. 20 years is a long time. Annual rent increases are attractive. Absolute triple net is attractive. Texas is attractive from a tax standpoint. On paper, this looks like a well-structured passive income investment. But structure alone doesn't make an investment safe. The lease only works if the business works. One of the biggest mistakes investors make is evaluating a business based on what it used to be instead of what it has become. Most people still think of car washes as a simple business. A customer pulls in, buys a wash, leaves, and hopefully comes back again someday. But that's not the model driving growth in today's industry. The real story is memberships. Rapid Express reports serving more than 200,000 members across its platform. Let's think about that for a moment. This isn't a company waking up every morning wondering whether customers will show up. This is a company that has spent years building reoccurring monthly revenue streams that are automatically charged whether it rains, shines, or customers visit that month. And that's exactly why private equity became interested. Investors love reoccurring revenue because reoccurring revenue creates predictability. Predictability creates higher valuations. Higher valuations attract more capital. Suddenly, what looks like a car wash starts looking a lot more like a subscription business with real estate attached to it. That's a very different investment thesis than most people realize. Whenever private equity enters an industry, I always ask the same question. What are they seeing that everyone else is missing? In this case, I think the answer is fairly straightforward. They saw fragmentation. They saw reoccurring revenue. They saw the ability to acquire independent operators and create larger platforms with better economies of scale. Rapid Express has grown from a single location into a multi-state operator with dozens of locations and plans for additional growth. The company is backed by Wildcat Capital, which has invested across multiple consumer-facing businesses. That type of institutional backing tends to provide resources and growth capital that smaller operators simply don't have. Now, before you get too excited, private equity involvement isn't automatically a positive. Private equity can accelerate growth, but it can also accelerate mistakes. And that leads us to the risk I think investors should be paying attention to. Whenever an industry becomes fashionable, capital starts flooding in. We've seen it in self-storage. We've seen it in senior housing. We've seen it in restaurants, and we're seeing it in car washes. So one of the concerns I have about the industry is whether certain markets eventually become oversaturated. If every successful operator is building more locations, acquiring more sites, and chasing membership growth, eventually there comes a point where supply can start catching up with demand. I'm not saying that's happening at this location. What I am saying is that investors need to understand they're not buying a sleepy utility business. They're buying into an industry experiencing significant expansion. And expansion creates opportunity, but it also creates risk. Now, let's talk about the real estate, because despite everything I've said so far, I actually think the location is one of the stronger parts of the investment. The property sits in San Antonio, one of the fastest growing major markets in Texas. Population growth, business growth, and continued migration into Texas have supported demand across multiple commercial real estate sectors. The location benefits from strong traffic counts surrounding retail activity, nearby residential density, and proximity to complementary businesses. One thing I always look for is whether other successful businesses have chosen to locate nearby. Strong retailers spend enormous amounts of money on site selection. When multiple successful brands cluster around the same corridor, that's usually telling us something important. And this location appears to benefit from exactly that dynamic. And that's important because while businesses can change, great locations often continue creating value for decades. Before we continue, I want to take a step back just for a moment to talk briefly about why investors continue allocating capital into commercial real estate. One of the things I love about real estate is that it gives you multiple ways to win. You can benefit from cash flow, you can benefit from appreciation, you can benefit from principal pay down through financing, you can benefit from depreciation and other tax advantages. And unlike many other investments, real estate allows you to use leverage to control a much larger asset with a relatively smaller amount of capital. Now, that doesn't mean every deal is a good deal, far from it. But when the right property, the right tenant, the right location, and the right lease structure come together, real estate can become a powerful long-term wealth building vehicle. The experienced investors I work with are rarely focused on getting rich next year. They're focused on where they want to be 10, 15, and 20 years from now. They're thinking about passive income, wealth preservation, inflation protection, and creating assets that continue working for them long after they've stopped working themselves. And in this particular deal, I think Texas deserves special attention. One of the reasons investors from California, New York, New Jersey, and other high-tax states continue pouring money into Texas commercial real estate is because Texas has no state income tax. That means the rental income generated from a Texas investment isn't subject to an additional layer of state income tax the way it often is in many other parts of the country. For investors focused on after-tax returns, that can become a meaningful advantage over time. In fact, Many of the 1031 exchange buyers I work with specifically target states like Texas, Florida, Tennessee, and Nevada because they want both income and the tax efficiency that comes with owning real estate in those markets. It's one of the reasons Texas continues attracting both businesses and investment capital at such a remarkable pace. By the way, if you're actively evaluating deals like this, or maybe you're in the middle of a 1031 exchange and need help identifying and analyzing the right investment property, you can contact me through the link in the description below. Now, let's get back to the deal. So for the million-dollar question, is this a good investment? For the right buyer, I think the answer is yes. If you're looking for long-term passive income investment with a 20-year lease, annual rent growth, and absolute triple net structure, Texas tax advantages, and an operator that appears to have meaningful scale and institutional backing, I think there's a lot to like here. However, I would not view this as a risk-free investment. The biggest risk isn't the building. The biggest risk isn't even the lease. The biggest risk is whether the growth assumptions behind the modern car wash industry continue to hold up over time. Personally, I think the 6% cap rate is reasonable given the lease structure, operator scale, and the market positioning. I don't think it's a screaming bargain. I don't think it's overpriced. I think it's a fair reflection of the opportunity and the risks. This deal is best suited for investors who value long-term stability and passive income more than maximum yield. Investors seeking the highest cap rates available will likely find higher returns elsewhere, but they'll probably be taking significantly more risk as well. What do you think? Does a 6% cap rate make sense for a private equity-backed car wash operator with a 20-year lease? Let me know in the comments. I love to hear your thoughts. Now that we've covered the strengths and the risks of this opportunity, the real question becomes, what type of investment strategy makes sense for you? Every investment carries risks, including triple net real estate. The difference is whether the risks are properly understood and whether the asset aligns with your long-term objectives. When it does, commercial real estate can become an incredible vehicle for building wealth through passive income, leverage, and appreciation. When it doesn't, investors can find themselves owning assets that no longer fit their goals. And that's really the key. Understanding not just the lease, but the tenant, the business, the industry, the location, and the long-term trends driving performance. And if you're looking to invest, sell, or complete a 1031 exchange and want help analyzing opportunities like this, you can contact me through the link in the description below. I also offer a free copy of my cap rate analysis system designed to help investors better evaluate risk, return, tenant quality, and long-term investment performance. I'm Mercedes Shaffer. This is the Commercial Real Estate Deal Room, and I'll see you in the next deal.